Welcome to Decoding Private Equity Metrics, NAV, TVPI, IRR, DPI, RVPI Explained. This video is designed for aspiring and current students, financial analysts, and anyone looking to deepen their understanding of private market performance. We'll demystify the core metrics essential for evaluating private equity funds, providing you with the knowledge to make more informed investment decisions and confidently analyze fund performance. By the end, you'll have a comprehensive grasp of what these metrics mean, how they're calculated, and why they're crucial. Let's get started. In the opaque world of private equity, understanding fund performance requires a specialized toolkit of metrics. Unlike public markets, where daily prices provide clear indicators, private markets demand a deeper dive into financial statements and valuation methodologies. That's where fund metrics come in. These metrics are essentially the language of private equity performance. They allow limited partners, or LPs, to assess how well a general partner, or GP, is managing their capital, the progress of investments, and the overall health of a fund. LPs rely on these metrics to evaluate fund managers, compare performance across different funds, and make critical decisions about future capital commitments. Without them, assessing true performance would be a purely speculative exercise. Each metric provides a distinct lens through which to view performance. NAV gives you a snapshot of value today. DPI tells you about value already created and returned. RVPI reflects value expected from unrealized assets, and IRR combines these with a time dimension. It's about getting the full picture. Before we dive into the more complex performance multiples, it's crucial to understand the foundational capital concepts in private equity. These terms form the bedrock upon which all other metrics are built. First, committed capital is the total amount of money that limited partners formally agree to invest in a private equity fund. Think of it as the maximum promise LPs make to the fund over its lifespan, usually defined in the limited partnership agreement. Next is paid-in capital, or PIC. This is the actual amount of committed capital that the general partner has called from LPs, and that LPs have actually funded. It's the cash that has moved from the LP's bank accounts into the fund's investment pool. Finally, net asset value, or NAV, in the context of private equity, represents the current fair value of the fund's underlying investments plus any cash held, minus any liabilities. It's essentially the fund's equity value at a specific point in time, usually reported quarterly. These three, committed capital, paid-in capital, and net asset value, are the fundamental building blocks. Understanding them is essential for correctly interpreting the more advanced performance metrics we'll discuss next. Let's explore NAV in more detail. While we just defined it as a core capital concept, it's also a critical performance indicator in itself, providing a snapshot of the fund's current health. NAV represents the fund's equity value at a specific point in time. It is calculated by taking the fair value of all portfolio companies, adding any cash the fund holds, and then subtracting any outstanding liabilities. This gives you the net value attributable to the limited partners. It's important to note that NAV can be subjective, as it heavily relies on the valuation methods used for illiquid private assets, techniques like discounted cash flow, comparable company analysis, or precedent transactions. This subjectivity means NAV fluctuates as portfolio companies grow, exit, or are marked down in value. Now let's differentiate between realized and unrealized returns. This distinction is absolutely fundamental in private equity, as it tells you whether profits have been turned into actual cash or are still on paper. A balanced assessment of private equity performance requires both. Realized returns offer certainty, they're cash in hand. Unrealized returns, on the other hand, represent potential future gains, dependent on successful exits and future market conditions. DPI, or distributions to paid-in capital, is a straightforward cash-on-cash return metric. It's calculated by dividing the total cash distributions received by LPs from the fund by the total capital LPs have paid into the fund. A DPI of 1.0x means LPs have received all their capital back in cash, and anything above 1.0x is profit. RVPI, or residual value to paid-in capital, represents the paper return, the current market value of the fund's remaining unrealized investments divided by the total capital paid in. It shows the value still held within the fund that has not yet been distributed to LPs. LPs scrutinize RVPI to understand the quality and potential of the fund's remaining portfolio, especially in later-stage funds. Now that we've covered the components, let's look at the comprehensive return multiple and how the time value of money is incorporated into private equity performance assessment. TVPI, or total value to paid-in capital, is the all-encompassing return multiple. It's simply the sum of DPI and RVPI. So TVPI equals distributions to PIC plus residual value to PIC. This metric gives you a complete picture of the total value created by the fund relative to the capital invested, encompassing both realized and unrealized gains. Finally, IRR, or internal rate of return, is perhaps the most widely cited metric, and it accounts for the time value of money. It's the annualized effective compounded return rate that makes the net present value of all cash flows, investments in and distributions from the fund, equal to zero. In simpler terms, it's the discount rate that balances the fund's inflows and outflows over time, giving you a percentage return that considers when money was invested and when it was returned. While powerful, IRR has its limitations. It can be particularly sensitive to the timing of cash flows. For instance, in early-stage funds, the IRR might look artificially low or even negative for several years due to initial capital calls and limited distributions, even if the underlying investments are performing well. This is part of the J-curve effect. Understanding how these metrics interact and evolve throughout a fund's life cycle is crucial for a complete picture. They tell a story that changes from the initial investment phase to the eventual liquidation. In the early stages of a fund, you'll typically see low DPI and potentially low or negative IRR due to capital calls and few distributions. RVPI, however, might start to grow as investments are made and valued. As the fund matures, DPI will increase significantly as assets are exited, while RVPI will decrease as remaining assets are liquidated. IRR will also stabilize, reflecting the actual performance. As the private equity industry evolves, so do the priorities of limited partners and the demands for more transparent reporting. Let's look at what LPs are focusing on now and what the future holds for performance reporting. There's a renewed and significant focus on DPI, as LPs increasingly prioritize actual cash distributions over paper gains. They are also scrutinizing the quality of RVPI more closely, asking about the liquidity and exit potential of those remaining assets. Similarly, the sources of IRR are being questioned. Is it driven by genuine operational improvements or just by market multiples? The demand for greater transparency and more granular reporting is growing. LPs want more detailed insights into underlying portfolio company performance, ESG factors, and the methodologies behind valuations. The future of performance reporting will likely involve a combination of these traditional metrics alongside new, more nuanced indicators. We've covered a lot of ground today, diving deep into the essential metrics of private equity. Let's quickly recap the key takeaways before our important disclaimer. You now understand committed capital, paid-in capital, and NAV as the building blocks. You know DPI for realized cash returns, RVPI for unrealized paper value, TVPI as the total return multiple, and IRR as the time-weighted performance measure. These metrics, used in combination, provide the most comprehensive view of a private equity fund's success. A crucial disclaimer: the information provided in this video is for educational and informational purposes only and does not constitute financial advice. Private equity investments involve significant risk and are not suitable for all investors. Always consult with a qualified financial professional before making any investment decisions. Thank you for watching, and we hope this deep dive into private equity metrics empowers you to make more informed investment analyses.